All right, today I want to talk a little bit about some common real estate terms. For folks who don't have a lot of experience in the lending world or the investment world, there's lots of lingo that can be a little confusing. And so today I want to kind of break that down. So we are going to start with looking at a real estate deal and what those numbers and terms mean, and then move to some lending terms to kind of get a full circle. So the most important thing when we're looking at a real estate investment opportunity, we want to understand what's the gross income. And so that is our collected rents. Now, typically, if you look at an investment deal, they'll say a kind of a pro forma gross rent. So assuming we're 100% occupied, this is what you'll collect. It's important to put an appropriate vacancy rate in that gross income. So if the property historically is at 85%, those are the rents I want to look at, not pie in the sky one day if we ever hit 100%. So we have gross collected rents, then we have our operating expenses. Those are typically insurance, taxes, if there's a property management fee in there, and then capital expenditures, things like roof repairs, HVAC repair and replacement, parking lot replacement, tenant commissions, broker commissions are in there, and sometimes tenant improvement allowances are in there. For instance, in an office building or a retail building, when a new tenant comes in, oftentimes that landlord will give them $10, $20 a square foot as an incentive to move into the property and to fix it up kind of how they want to. So we've got our gross income, we have our expenses, and after that we get to our net operating income. And this NOI is a really, really important number here. This is what we are going to make before we pay any debt service. And the net operating income leads into a another really important term, a cap rate or a capitalization rate. And a capitalization rate is essentially if we paid all cash for a piece of property, what my annual return would be. Oftentimes investors put debt on the property, and so your return will be a little bit higher than your cap rate because you're using leverage. But that cap rate is a very good indicator of quickly, should I dive deeper into this opportunity or should I throw it in the trash can? It's also a great way to compare side-by-side deals. Now, while all real estate is different, if we're looking at two different self-storage deals and one's a 6 cap and one's a 10 cap, I want to dig a little bit harder into this 10 cap opportunity to figure out, am I missing something? What's going on here? And to find cap rate, we divide our income, our NOI, net operating income, divided by our purchase price. So just for round numbers, if our NOI is $100,000 a year and our purchase price is $1 million, our cap rate is 10%. We've talked about gross income. We've talked about our expenses in order to find our NOI, which leads us to our cap rate. So now we've kind of looked at a high level, the investment that we're evaluating. Now we want to take this to a bank. And the bank has their own separate metrics that they're worried about. One of the most important things is called debt service coverage ratio, or DSCR. What that means is this is kind of a stress test is what banks are looking for. They don't want the payment to be $1,000 a month and you make $1,000 of profit a month because there wouldn't be any margin of safety there. And so oftentimes the debt service coverage ratio needs to be 1.3 or higher in order for the bank to feel comfortable. And so let's just say the annual debt service is $100,000 a year. So over 12 months, you pay the bank $100,000 in principal and interest. The debt service coverage ratio needs to be 1.3 or higher, which is $130,000 or higher. So as the owner of the property, it has to produce $130,000 of profit a year or more in order for the bank to lend on this. A few more really important bank terms are obviously the interest rate. What are we paying in interest each year? Our amortization rate. For residential property, you can get a 15-year amortization or a 30-year amortization. And what that means is, it's the loan divided by either 15 years or 30 years for a full payoff. In commercial, it's a little bit different. Typically, you'll get a 5-year balloon note. So the bank says, listen, we'll fix this rate for 5 years for you. and you can amortize it over a 20-year period or sometimes a 25-year period, depending where we are in the cycle. So then after 5 years, the bank gets to say, we'll renew this loan for a different interest rate. Sometimes it's higher, sometimes it's lower, or maybe you need to go somewhere else and take this loan somewhere else. So this just kind of hedges the bank's ability depending on the interest rate environment. And the last really important metric we like to look at is your cash on cash return. And so that is the money left over after your expenses. So we have our net operating income. After we pay our debt service to the bank, the money left over in our account to spend divided by our initial investment or our down payment. And that often can be found just on the back of a yellow sheet of paper. And that's what I love about real estate so much, is often the best deals don't need to be complicated. They don't need to be run through 8 different tabs of the Excel model. Oftentimes with a regular calculator and one legal sheet of paper, you can figure out, is this a good deal or a bad deal, a go or no go. I hope this was informative and gives you a little bit of peek into how we think about real estate.